Okay, guys, let's move to the income statement of the PSA corporation. So, from July till December, this new business they worked, they went into operations, and they produced and sold the scanners. So, this is the 6 month income statement starting from 1st July until the 31st December. So as you remember that balance sheet is just a snapshot. So the balance sheet is actually the financial position of the assets held by the corporation on a particular date. This is not true for the income statement. Income statement is for a particular period. Like you earned the income for 1 month and then you get the salary. So whenever someone asks you, they ask you, okay, what did you earn in the last month? They talk about the period, the whole period, 30 days. So likewise, income statement can be of any period, 6 months, 3 months, 1 year. In this case, in case of PSA Corporation, the income statement is for the 6 months, starting from 1st July and until 31st December. So during this 6 months, the PSA corporation sold 1200 units or 1200 scanners. So this data is just I'm giving you over here. So they sold 1200 units, and these 1200 units, remember, were sold. This data was already given in the first video. This is the basic data that the per unit price is $100. So if you multiply 1200 with $100, you'll get $120,000. So this is the net sales. This is the revenues of PSC Corporation during the 6 month period. And the thing is this, that then you have to subtract the cost of goods sold. This red in color. Let me just make it bit bigger so that you can easily see that. So now, yes, so they, if you subtract from 120,000 this 78,000, you will get 42,000. So 78,000 is what? It's a cost of goods sold. It is the direct cost of making those scanners. So that the cost, the components of the cost will be the basic materials used in the scanner, or the labor of the people who assemble the scanner will come under the cost of goods sold. The cost which you can directly link with the product which is going to be sold. So this is 78,000. So in making the scanners throughout 6 month period, the they basically like in making the scanners which they eventually sold. So it means that these 1200 scanners which they have sold, in making them they incurred 78,000 expense during the 6 months starting from 1st July until 31st December. Remember, they might have been making more than 1200 scanner in the 6 months. So the others are simply in the inventory by the end of the 31st December, which they are not going to be sold. So their cost will not be included. The unsold scanners cost will not be included in the cost of goods sold. Those will actually come under the asset side of the balance sheet within the head of inventories. We will discuss it. I'm going to discuss it very soon in this video. So 78,000 is the cost of those, the basic material and labor cost of those scanners which PSA Corporation has sold during 6 months, whose worth was $120,000, because the $100 was the price and $1,200 units were sold. So 78,000 is the cost of making those 1,200 units. So once you subtract this 78,000 from 120,000, which is the net sales, you will end up getting 42,000. This is actually the gross earnings or gross profits. So you can also see the cell S5 minus S6. So I included a formula over here that I subtracted S6, which is 78,000. This cell is S6 minus, it is getting subtracted from S5, which is this one, this cell, this one. So this is S and then this is 5. So this cell address is S5. S5 minus S6, you will get 42,000. Now we will go towards the operating expenses. So cost of goods sold is actually the direct cost of making those 1200 units which eventually PSA sold. Then apart from that, there would be many other operating expenses. For example, utilities, the salaries of the administrative staff. Now, administrative staff was not involved in making or assembling the scanners. So, though they are working, but their cost, their will not, cannot directly be linked with the preparation of the scanner or assembly of the scanner. So those administrative costs, marketing or advertisement costs, they will come separately. They will not be included in cost of goods sold. So they will come under the head of bigger head of operating expenses. So the bigger head is operating expenses, and then there is a further breakdown in that. So because this is a new startup, and for the purpose of elaboration, I'm also trying to keep things simple. So there are only 4 expenses I have mentioned over here, because but in a big company, in a big corporation, there could be many items under the heading of operating expenses. So first of all, there is marketing expenses. So say the company has spent 12,500 on advertisement or marketing in order to generate sales. So this 12,500 will come over here. Then there is an administrative expense. Remember from the previous video, the data is this, that there will be a $3,000 salary per month for the owner. So because this is the income statement for 6 months, so if you multiply 3,000 salary with 6, so it means that for 6 months, and each of those 6 months the owner kept getting his salary of 3,000. So if you multiply 3,000 with 6, you will end up getting 1,800, which is the administrative expense. So it is actually over here the salary or which the company has paid to the owner for working 6 months. And then again, this is a new venture, so the owner decided to rent the building for the company's office, and the rent of each month was 1,000. So for 6 months, the total building rental is going to be 6,000. And finally, we have depreciation expense, because the equipment was used during 6 month time period. And remember, the equipment was bought at 20,000, and in the initial data I have already given in the part 1 video, that the price is 20,000 and useful life of the equipment is 10 years, and there is a straight line depreciation method. So if you divide 20,000 with 10, you will get 2,000 per year depreciation. So because this is per year depreciation, so for the 6 month, the depreciation will be half of what would be the depreciation of the whole year. So if you divide 2,000 with 2, you will get 1,000. So that 1,000 will go over here. So this is the depreciation expense. Now if you add all these operating expenses together, like from S9 to S13, you will get the total operating expenses. So if you add 12,500, 18,000, 6,000 and 1,000, they will give you the total operating expenses, and this is the total operating expenses, which is 37,500. Now if you subtract this 37,500 from the gross profit, you will get EBIT, which is also called earning before interest and tax. So look over here, I'm subtracting this cell, which is S14. I'm going to subtract it from S7. So look, S7, which is this cell, right? This cell, I am subtracting from this S7 this total operating expenses. So I subtracted from gross profit the total operating expenses in order to reach to earning before income and tax. So this is the earning from which the PSA Corporation has not yet paid in interest and the tax. So what is now the interest? Again, remember this guy, the entrepreneur of PSA Corporation, he borrowed $10,000 from his friend as under the long-term debt. Look over here, this one, and he's going to pay him 10% each year the interest of using his money. So 10% of 1,000 is 10,000 is $1,000. So if you take the 10% of $10,000, you'll get 1,000. So each year he needs to pay him $1,000 as a rent of using his money. So if, because this is again the statement for the 6 months, so if you divide 1,000 by 2, because 1,000 is for the whole year, the interest expenses for the whole year, but for the 6 month then it will be $500, because 1,000 divided by 2 will give you 500. So now this is the interest. If you subtract now interest from EBIT, which is earning before income and tax, you'll get EBT, like the earning from which just tax need to be paid. So tax has not yet been paid, and all the other expenses has been paid from this earning. Even the interest expense has been paid from this earning. So like by from the meaning of paid, I mean to say that these expenses have taken away from these sales or the revenues already. So this earning is your final earning, just you need to pay the tax from this. So if the tax rate is say 25%, then 25% of 4,000 is 1,000. So this is the tax 1,000, because the tax rate is 25%. So you have to multiply EBT, earning before tax, with the 25%. So you will get 1,000. So 1,000 becomes your tax. If you subtract now tax from EBT, you will get finally the net income. So this is actually the balance sheet, the income statement of PSA Corporation. Now we want to know that from where this 78,000 came. This is an important question to ask. And in my third video I will, in fact, the third video of this series, I will talk about this. Thank you.